Hello, Accounting Superstars. This is Professor Don Bush from the Accounting Superstar channel. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. You've come to the right place. Boy, today I live in Colorado at about 8,500 feet elevation, and it's a cold one today, and tonight we are supposed to get a ton of snow, and it's supposed to continue snowing Saturday and Sunday, so we'll see what happens here. I might be buried. So today's lesson is the units of activity depreciation method. And this is a very common method, especially for industrial machinery, things that are used on an hourly basis rather than, or driving miles in this case, here, rather than time. And so here's what's going on. We've got this van. Fred's Snowblower Service is buying this beautiful blue van, and they bought it for $15,000. The value at the end of the useful life is expected to be about $3,000. So they also expect it to be driven for maybe the next 5 years or 100,000 miles. And so what we're going to do is we're going to depreciate this truck over the number of miles that it's driven. So it's a little different than the straight line method, although there's a lot of similarities. And the miles driven in the first year are 16,000 miles, so we'll use that number 2. So here's the formula, folks, to figure it out. There we go. It's cost, that is the original cost, $15,000, minus the salvage value. Salvage value at the end of the useful life of 100,000 miles, $3,000. So far we've got the cost of $15,000 minus $3,000, and we're going to plan on using this van for 100,000 miles. So here's the formula: cost minus salvage divided by the expected miles. And if you do the math, you're going to get 12 cents a mile. So every time they drive this van a mile, they'll depreciate it 12 cents. So during the first year of operation here, the first year of using the van, they drove the van 16,000 miles, delivered a lot of packages, a lot of snow blowers. And so all we do, it's just this simple, folks. All you do is take 16,000 miles times 12 cents per mile, and that will be the first year's depreciation. Now, during year 2, they'll probably drive it a different number of miles. Maybe they'll drive it 20,000 miles or 10,000 miles. Who knows? But in the first year, they drove it 16,000 miles. 16,000 miles times 12 cents a mile is $1,920. Now, the journal entry is very similar to straight line. The exact same debit and credit. We're going to debit depreciation expense and credit accumulated depreciation, and it'll be for the $1,920. Now, expenses flow onto the income statement. So this expense of $1,920 will go right on the income statement. And on the balance sheet, the delivery truck will be listed at its original cost. The original cost is $15,000. So here we go, $15,000. And the accumulated depreciation at the end of the first year is $1,920. Now that accumulated depreciation, that will accumulate as the years go by and as the miles are driven. So next year it'll be a bigger number, and after that a bigger number. And the book value, folks, the book value is $13,080. All we do is subtract 15,000 minus 1,920, and you get $13,080, and that's the book value. The book value is according to the books. That is what the van is worth at the end of the first year. Now, we ought to know by now that market value and book value are two totally different things. Book value is what the van is worth according to the books, and it may not reflect reality. So, ladies and gentlemen, if you enjoyed this video, hit that like button, hit the subscribe button. It helps out the channel a whole lot. And check out accountingsuperstars.com. It's a great website. I've got all my videos listed by topic. So if you're searching for a certain topic, maybe you'll find it there. accountingsuperstars.com. Until next time, over and out.